Good morning, I'm Chris Beach, and welcome to Charter Markets on IG Live. A slightly more positive start to the session for European markets and US futures picking up a touch after a very gloomy start to the final quarter of the year. Q4, of course, as you probably heard me say plenty of times before, and it's usually quite a positive one for equities, although the start can be a bit choppy. And that's exactly what we got yesterday. It picked up essentially where Q3 finished on Friday, and despite that deal to avert a US government shutdown, markets didn't really take it very well. I think mainly because we know it's a temporary deal that only gets us through the next 6 weeks, and then we have to do the whole thing all over again. So a very limited positive boost for stocks there over the weekend. And then looking at other factors yesterday, you had a number of Fed speakers coming out and saying once more that rates will stay where they are for an extended period. Not that they would continue to go up, but they just weren't coming down anytime soon. And that really reiterates what we had from the Fed meeting back in September, but certainly doesn't do any favors for anyone hoping for maybe a reason to buy back into stock. So while you just have some opening moves higher, particularly on Wall Street yesterday afternoon, the day finished broadly lower, except for the Nasdaq, which we'll come to in a second. Not much else to report in terms of fundamental news, although the main thing to watch, of course, is the yen and the strength in the dollar and the weakness in the yen, which has brought forth a couple of comments from the Japanese Ministry of Finance about possible intervention. Well, actually, they said we're watching the level, which is Ministry of Finance code for we're thinking about doing something. So that's something to keep an eye on in the next few days as we start to warm up into Q4. Otherwise, it's all about dollar strength. Gold suffering heavily over the last week or so, and you've got oil prices finally showing a bit of weakness, although it only puts a small dent in what has been an impressive rally there since June. We're going over to indices and starting with the Dow, currently trading at 33,447, and that's above yesterday's low. We briefly touched the lowest level there since the beginning of June for the Dow, but no sign really that it wants to head any lower. Really, I think we saw it hit as a low of around 33,230. In fact, that's back to where it was at the end of May. Sorry, I do correct, right at the beginning of June. Sorry, 2nd June, we had that big surge to start the June, and then we saw that quarter get underway in fine style. Well, it didn't end too well for the Dow, of course. We find ourselves back where we were. Of course, what we saw on Friday was that attempt and that failure to break above the 200-day moving average, which has now moved to more of a flat posture, having steadily risen since June and July. So that's a bit of a negative sign, or at least not a very positive sign. And a lot of ground's been made up to suggest that maybe we've seen a low in the Dow for the time being and that we're back on the up. I think you would want to see it back above that 200-day moving average. So back above currently 33,832. But in defense of this support zone that might be forming, really. And of course, I always think of support as rather a zone rather than just a strict line. So you can see the dips into this area around 33,300, all the threes, finding some buying pressure over the last week or so. Admittedly, not enough to drive it higher, but as I always like to say, markets have to stop going down before they go up. It's not clear we've entered that phase yet, but certainly a bit of attempt to push this one slightly higher for the Dow. Otherwise, closed back below 33,230. Really, the next big thing to watch is, of course, these May lows all the way down 32,700 or so. Moving over to the Nasdaq, and this is the interesting one in some ways because yesterday, and indeed all the way through the middle of last week, it started to rally, bottomed out around those August lows, 14,550. And it started to rally all the way through last week. And while it did get knocked back on Friday, it then recovered on Monday. So it's interesting to see with all European indices down and the US indices suffering heavily, particularly small caps, the Nasdaq showing signs of strength, which might be just an anomaly. Certainly Apple and Nvidia were up yesterday. It might just be a brief moment in the sun before another leg lower. But maybe if there were signs that it was bottoming out, you might expect to see it happening first in the Nasdaq, so something to watch for. Admittedly, we've not been able to breach the highs from Friday and Monday session around 14,900. So that's the line in the sand, if you like, in the short term, to say if it closes above there, you might be able to muster a slightly more short-term positive view. But the next hurdle from there would be trendline resistance from that July high. So coming to play around the 15,300, something to keep an eye on, really. And above that, Then you've got these lower highs around 15,530, and then the ones from July itself around 15,760, and then up to 15,900. So if we close, like with the Dow, if we close back below last week's lows, clearly that has initiatives to the sellers. And for the Nasdaq, the risk is that you could get a bit of a whoosh moment. Firstly, down to these early June lows around 14,230. That's the first thing to watch out for. And then below that, you've got the rising 200-day moving average all the way down at 13,687. We haven't touched the 200-day moving average since March. So I think it's just worth putting this into context that, yes, the Nasdaq hasn't really gone anywhere since June. If you look back to where it was right at the beginning of March, it's still a very impressive performance for the year, and not surprising just to see this period of consolidation. Speaking of markets that consolidate, here's the DAX, which is still up strongly for the year and well up on where we were a year ago. But again, we've said this more than once on Charting the Markets, but it's been consolidating now since April. And in fact, it's back to now where it was as it rallied out of that March banking crisis. If you can remember, cast your minds back to when the world seemed to be ending the last time around, and we thought the banks were under pressure once more. Market shrugged that off. You had a rally. And the DAX now fighting to hold. Again, you can see this buyer stepping in around this 15,200 mark. For whatever reason, that's where they're stepping up for the time being and are trying to sort of halt these losses that you see, this big downward move from the end of July. Of course, I was reminded that when we were writing up the technical analysis on the DAX this morning, that was a record high for the index just at the end of July. So that was what, 2 months, just over 2 months ago, the DAX sitting at a record high. So in some ways, perhaps it's not surprising to have had this admittedly quite dramatic pullback, around 9%, wiped off the index. But as ever, it's the way that markets fall much faster than they rise. And that's exactly what you've had here for the DAX. 15,200, the line in the sand for the time being, closed below that and opens the way again to this March. I said low, you can see how long these wicks are. The actual low is 14,458, but really more or less quite a lot of buying around the area 14,800 or so. So that's where maybe we'll see a more substantial buying momentum step up in the short term. Problem for the buyers, of course, is that you could rally all the way back to 15,600 and still hit trendline resistance from that record high. So there's a lot of work to be done here before you can really say the index has bottomed out. But in the short term, the rebound perhaps in that direction would not be surprising. Moving to FX markets, and the euro continues to make headway against the pound, at least, with the Tory party conference on in Manchester. Not much, of course, in the way of concrete action, but certainly plenty of promises. And with party conference even going on, that's going to dominate the news for a while. But concerns about inflation in the UK haven't gone away. It's just that the Bank of England appears to signal that it is mostly done with hikes for the time being, which has given the euro some room to make further headway against the pound. And you can see that there, that we have seen these higher lows all the way through since the middle of August. So buyers holding on to control here. And crucially, as you can see, these highs from July and August around sort of 86.60, we're now holding in that zone. We didn't drop back below it. And now we're pushing back perhaps towards that 200-day moving average. So quite the rounded bottom forming here in euro sterling. And a close above the 200-day would then take us onto these highs from May at 87.30. So something to watch there for the euro against the pound. Looking at the pound against the dollar, not much relief here, clearly, because with the Fed talking up its game on rate hikes, or at least keeping rates where they are, and the BOE saying essentially we're done. It's not much to choose between those two, but it's enough of a hawkish commentary from the Fed to give the dollar the edge here, knocking the pound to its lowest level. Yet another bad September for the pound, just a year after the last one, back to its lowest level since March. Really unwinding a lot of this rally now, as you might expect, given the changing circumstances. For the sellers, I think you're now looking for this 11,920, 11,930 area that marked some support in the second half of February, with the March low, again, that banking crisis low down at 118 thing to keep an eye on, really. Lots and lots of declines here, lots and lots of potential trendline resistance coming into play. So You could argue maybe it is overstretched. People saying, oh, the pound's oversold against the dollar. Well, it kind of is, but oversold is just an indication really of momentum. It isn't a sign that a bounce is impending. You certainly saw that last week with the attempt at a rally back above 122 on Friday, building on what we had on Thursday. That was rudely knocked back by the sellers. They came in, they saw an advantage and took it, and now we find ourselves back at these lows. So we are probably overdue a rebound, but that's the kind of bland thing that really can't. We wait for the catalyst. We don't know when that will happen, but that could still yet create a lower high, maybe below 124. Anything below 124 will be a lower high and maintains the negative view on the pound against the dollar in the medium term. Not much love for the Aussie dollar either, really dropping today to its low, to a fresh low for the year, its lowest level since November. And again, such a miserable year for the Aussie, for many reasons, because the RBA started to pause before a lot of other central banks, and especially against the Fed, which is, as we've said ad nauseam, ramped up this hawkish rhetoric, or at least saying we're not touching rates, they're not changing, they're not being cut for at least another, well, half a year and probably more, another sort of 9 months at least, unless things change dramatically. And so you can see really how the Aussie dropping through this area of support. I think buyers have been determined to try and hold this one around 63.50, 63.60. Close as looks likely today here, barring some kind of short-term recovery, an impressive recovery back above 63.60. The sellers have reopened this one, and now it's a target down to these October lows at 62, 46 looming for this currency pair. And then to commodities, it's been a miserable week for gold, unsurprisingly. If you've got the dollar rising, that always hurts commodity prices, but you've got yields on the up as well. So why would you hold gold when you've got income producing assets in the form of bond yields? And that's exactly the rationale. That's what's driven gold, essentially. It's down to its lowest level here again since March, and on the cusp of testing this 1806, 1807 level, really, that we last saw again at the end of February, completely unwinding most of the gains made this year. And as you can see, it's been tough being short gold since July, because you've had repeated attempts at a rally when you thought it was going to break much lower in August. It then rallied, dipped back in September, rallied again, and then finally you got the payoff. Sort of patience is obviously half the battle sometimes in trading with proper risk management, but that's exactly what you had. Finally, a move to the downside, and how death cross as well, just to add to the drama, and gold prices slumping to their lowest level in 7 months now. Again, no sign of recovery. Yes, it's off the lows in short-term trading this morning, but as yet, you can't really say that it's stopped going down. I think that's the key thing. Otherwise, if it closes back above 1850, that might be the thing to look for, really. But you then get a rally back in the direction of 1900. But again, trendline resistance from these July highs could mean that we go all the way back towards 1916, and we'll still be firmly in a downtrend, and you might see sellers hit it once again. So tough times for gold bulls. On a longer term view, maybe you can argue a defense of 1807 might precipitate some more buying, assuming the dollar somehow weakens because the Fed can't get more hawkish. That's an interesting thesis. It doesn't have much behind it at the moment, but that's the way some people might look at this one, and you might get a bounce. But at the moment, it's very hard to muster even a short-term bullish view. And then finally, crude oil. WTI finally dropping back over the last 3 days. Some signs of dip buying, if you like, this morning in oil prices. If you're looking for trend lines, we're just a short distance away from a potential one here around 86.70. So maybe some buyers come in here and push the price back above 90. It looks like the fundamental thesis of being long oil is still in place, and the fact that demand has at least not got worse, I think, is the way to look at it, and supply has remained relatively tight. There were talks last week about the low level of inventory supply in the US, which helped to drive the price briefly to a new high for the year. Unsurprisingly, it then dropped back with a stronger dollar taking its toll, but certainly very much in an uptrend there. You saw the dip buyers come in August on that weakness. Be interesting to see if history repeats itself here. And certainly with the 50 and the 100-day moving averages both above the 200-day, it does look like we've got a trend change here after a very torrid time for oil prices over the course of the second half of 2022. So look to the rest of the day, not very much, although we do have the monthly JOLTS survey in the US, the job openings survey, which has taken on a bit more importance as we look for signs of any potential weakness in the US economy following that surge in US interest rates. Admittedly, not much sign of that really. The Dow finished the day down about 70 points yesterday. We're expecting it now to open around about 15 points higher, 33,440 or so. So a slightly positive open. As I said, the Nasdaq showing more signs of strength really than the Dow. Something to watch perhaps, but overall not a great start to Q4. We'll see where that starts to change, but this week's main focus of course ADP numbers tomorrow and the infamous non-farm payrolls on Friday, so do tune in for that live on IGTV. That's it for me. Thank you for joining us. We'll be back as normal tomorrow at 10:30.